What if I told you that a trader sitting in some office in Hong Kong,
Right?
making a highly leveraged bet on the Japanese yen, is the exact reason your Bitcoin portfolio crashed 50% last week?
I mean, it sounds completely absurd on its
It
face.
really does,
Yeah.
because we are taught that markets operate on, basic supply and demand.
Yeah, exactly.
Like you buy an asset because you believe in the company or the technology, and the price goes up. But today, we're looking at a financial system where those old rules are just, well, they're completely dead.
Yeah, they are.
Welcome to the deep dive. We know you are here because you value your time, you are fiercely curious, and you want to cut through the absolute noise of the global financial machine.
And today's mission is highly specific. We are taking this massive stack of research. So we've got macro data from 42 Macro and Wolf Research.
Right.
We have structural theories from Raoul Pal, market mechanics from Mark Meldrum and Anthony Pompliano, and behavioral insights from Howard Marks.
That is a heavy lineup.
It is, and we are extracting the truth about where these markets are actually heading. We're going to analyze macro volatility signals, peel back the layers of options market data, and dissect cross-asset correlations.
Basically, to uncover what implied volatility and options flow actually reveal about the real mechanics of our economy.
Exactly, because the surface-level economic indicators, they just aren't telling the whole story anymore.
No, they're really not. I
Oh.
mean, if we want to understand why a currency fluctuation in Asia vaporizes crypto wealth in America, we have to start at the foundation.
Right.
We have to look at the single largest macroeconomic force that is currently warping all of our historical models, which is, of course, the exponential shock of artificial intelligence.
Yeah, and to understand why the old models are breaking down, we really have to look at the physical limits of economic growth.
Okay, let's unpack this.
Well,
Because,
think about it. For all of recorded human history, economic output was fundamentally constrained by human biology, right? By carbon.
a person can only work so many hours in a day.
Exactly. You can only think so fast, produce so much. But Raoul Pal introduces this concept of the economic singularity
Right, which happens when we shift the primary engine of productivity away from carbon.
over to silicon. Because compute processed through silicon operates, millions of times faster than human cognition.
Okay, yeah, let's unpack this a bit more.
Yeah.
Because Powell brings up the math behind this shift, and it completely breaks standard economic forecasting.
Oh, totally.
Most of us are familiar with Moore's law, the idea that computer chips get faster and cheaper over time.
Right, or Metcalfe's law.
Yeah, which states that a network becomes exponentially more valuable as more people use it, like the telephone or the internet. But Powell argues we're actually entering the era of Reed's law.
Yeah, Reed's law it's essentially the double exponential. It describes the utility of large networks, but specifically networks that allow for the formation of smaller subgroups.
Okay.
So in the context of AI, we are moving toward an agentic economy.
Wait, what does that actually mean on the ground?
It means this isn't just humans using AI as a tool anymore. This is autonomous AI agents negotiating, transacting, and executing contracts with other AI agents.
At machine speed.
Exactly.
Yeah.
Completely invisible to the human eye.
And the economic implications of that are just staggering. I mean, historically, a thriving, healthy economy sees a gross domestic product growth of maybe, 3 or 4% a year.
If we're lucky, yeah.
But Powell suggests that an agentic economy could theoretically push GDP growth to 10, 20, or even 30% annually.
It is a total paradigm shift.
But then, we have Stephanie Roth, the chief economist at Wolf Research, who brings a very grounded perspective to this futuristic vision.
Yeah, she does.
She agrees that AI is this profound long-term disinflationary force because it ultimately collapses unit labor costs.
Yeah.
But her data shows something very different happening right now.
Right. Specifically, she's tracking a 15% year-over-year inflation spike in computer software and accessories. And this is the critical tension, right, between the theoretical destination and the actual physical reality of getting there.
Because to build the infrastructure for this super intelligent automated future,
You need immense physical resources today. You need rare earth metals, massive data centers, specialized cooling systems, and just an unprecedented amount of electricity.
which creates an immediate, severe supply shock in the physical world.
Yes, even as the technology promises, infinite digital abundance a decade from now.
I look at it like building a state-of-the-art 10-lane futuristic highway system directly through the center of a crowded historic city.
Oh, that's a great way to put it.
The construction itself causes unbelievable localized traffic, detours, material shortages right now. The cost of concrete and labor skyrockets in that specific area.
Right.
But eventually, years down the line, the highway opens and it drastically speeds up the entire economy, lowering the cost of transport for everyone.
But the problem is we have to live through the construction phase.
Yeah. Exactly. Which brings us to the most glaring contradiction in the current economic landscape.
Yeah.
If AI is paving the way for this utopian era of long-term abundance and deflation, why does the everyday consumer feel like they're being financially suffocated?
Right. If we move from the high-level macro theory down to the street level, the narrative just fractures.
It really does. Anthony Pompliano recently spent time outside a Jay-Z concert at Yankee Stadium doing street interviews with everyday people just to gauge their financial reality.
And the anecdotes are brutal.
They are. People aren't talking about AI productivity gains. They're talking about $20 eggs and $12 jars of peanut butter.
Yeah, and rent in New York City hitting all-time highs.
One individual told him outright, quote, "They squeeze us for every dollar."
And yet, when Stephanie Roth analyzes the official macroeconomic data from Washington, the models show a resilient consumer.
Which is wild.
Right. The official reports point to solid payroll numbers and steady, albeit slow, income growth.
So how does she explain the disconnect?
She explains this profound disconnect by separating the price level from the rate of inflation.
Meaning the actual price tag on that jar of peanut butter spiked dramatically during the post-COVID supply chain crisis, and it just never came back down.
Exactly. The price level is permanently higher.
So consumers who logically anchor their expectations to what things used to cost in 2019 are furious.
Yeah, but the official data is only looking at the rate of change today.
So the rate at which that expensive peanut butter is currently increasing has cooled down to normal levels.
Precisely. The data says inflation is beaten because prices are only going up 2% a year now.
While the consumer says the economy is broken because their grocery bill is 50% higher than it was 5 years ago,
Yeah.
and their wages just haven't caught up.
Yeah.
I have to push back here, though.
Yeah.
If the official seasonally adjusted spreadsheet says the economy is fine, but the people actually buying the groceries and paying the rent say they are drowning,
Right.
shouldn't we trust the actual behavioral psychology of the consumer over a smoothed-out government data point?
Well, especially when we look at how that data is collected.
Exactly. The Michigan Consumer Sentiment Survey, which is a huge benchmark for consumer confidence, they recently changed their methodology.
Yeah, they shifted from conducting phone interviews to online surveys.
And more importantly, the current sampling breakdown is roughly 2/3 Democrats to 1/3 Republicans.
Right. And just to be clear, we are not endorsing any political viewpoint here.
No, not at all. But purely from a data science and statistical perspective, when political affiliation heavily influences how people perceive the economy, a skewed sample size creates a totally distorted picture of reality.
It is a fundamental problem of measurement. But regardless of whether the official data is perfectly accurate or structurally flawed, the feeling of financial exhaustion is very real for the working class.
Very real.
And this visceral pain at the street level is forcing the hand of the central banking system. The macro volatility signals surrounding the Federal Reserve are currently flashing bright red because they know the system is straining.
Enter the analysis from 42 Macro, focusing on Kevin Warsh, who is a highly influential voice in central banking circles.
Yeah.
Warsh has been very vocal about his opposition to what is called K-shaped monetary policy.
Right. A K-shaped economy, which is a term popularized by Dr. Peter Turchin, it functions as a structural wealth pump.
Okay, break that down for us.
So when a central bank keeps interest rates artificially low for extended periods, it inflates the value of assets. Stocks, real estate, fine art.
Right.
That pumps wealth directly upward to the top 10% of the population who actually own those assets.
Meanwhile, the resulting inflation outpaces wage growth, aggressively siphoning purchasing power away from the bottom 90%.
Exactly. And Warsh sees the social and political destabilization this wealth pump creates, and he is trying to dismantle it.
So the analysts at 42 Macro, they frame this challenge by breaking down the 4 paradigms of sovereign debt disease.
Yeah, this is fascinating.
When a nation has too much debt, there are really only a few ways out. Paradigm A is the debt itself. Yeah. Paradigm B is cutting spending, which, let's be honest, is politically impossible in most democracies.
Yeah, no one gets elected on austerity.
Exactly. Paradigm C is growing your way out of the debt through massive productivity gains, which is where the AI narrative comes back in.
Yeah.
And paradigm D is just printing money to inflate the debt away, Warsh's entire goal is to do whatever it takes to avoid Paradigm D, the printing press, and buy enough time for Paradigm C, the AI growth phase, to take hold.
If we connect this to the bigger picture, the mechanics of how he is trying to buy that time are directly responsible for the volatility we are seeing in the options and derivatives markets today.
How so?
Well, Warsh advocates for a strategy that 42 macro compares to a play action pass in American football.
Okay.
You fake the run to draw the defense in so you can throw the ball deep. In monetary terms, Warsh wants the Fed to act cyclically hawkish right now, keeping rates higher, talking tough on inflation to set the necessary conditions for structural easing in the future.
The crucial detail here is that to execute this hawkish posture, the Fed have completely abandoned forward guidance.
Yes.
They are no longer holding the market's hand and telegraphing their interest rate decisions 6 months in advance. They are forcing the market to be data-dependent.
Which means every single new data point, every jobs report, every inflation print, it forces institutional algorithms to instantly reprice their models.
Creating violent macro volatility.
Exactly. This shift in central bank behavior caused historical cross-asset correlations to just break down in spectacular fashion.
Because when Warsh's influence became clear to the institutional players, the market suddenly realized that the era of guaranteed endless money printing the debasement trade was under serious threat.
Right, and look what happened. Gold, historically a safe haven, dropped 10% in a single session.
Silver plummeted 20%.
Yeah. The market had aggressively priced in the devaluation of the dollar, and the Fed's new playbook forced a violent liquidation of those bets.
Because Warsh is keeping the market guessing, institutions are aggressively hedging their bets. And when you look at where they are placing those hedges, it leads us directly into the mechanical plumbing of the options market.
It does.
Which brings us back to the question I asked at the very beginning of this deep dive.
Ah, yes.
How does a currency shift in Asia destroy Bitcoin portfolios in America?
To understand the crash of Bitcoin down to $60,000, which was, a 50% collapse from its all-time high of 126,000, we really have to examine the financialization of the asset.
Okay.
Bitcoin was engineered to be the ultimate scarce asset, hard-coded with a maximum supply of 21 million coins.
Right, that's the whole pitch.
But Wall Street has built a towering structure of derivatives on top of that base layer.
Wait, hold on. If there are only 21 million Bitcoin mathematically allowed to exist in the software, how can Wall Street just create more?
Through the creation of synthetic supply.
Uh-huh.
Let's walk through the mechanics. Say an institution buys one physical on-chain Bitcoin. They hold it in custody, and they issue shares of an ETF against it.
Makes sense.
But simultaneously, offshore exchanges are offering perpetual futures contracts tied to the price of that ETF. Then, market makers who facilitate options trading on those futures have to hedge their book.
That's called options delta, right?
Exactly, options delta. They do it by dynamically shorting or buying the underlying asset.
Wow.
Suddenly, through the magic of financial rehypothecation, that single physical Bitcoin is backing an ETF share, a leveraged futures contract, an options delta hedge, and a structured note.
You effectively have 6 paper claims trading on one single physical coin.
Yes.
Here's where it gets really interesting. When we analyze the options flow data during this 50% crash, we look at BlackRock's Bitcoin ETF, ticker symbol IBIT.
Yeah.
On the day of the crash, it saw its highest volume day in history. $10.7 billion traded, with $900 million just in options premiums.
Staggering numbers.
But the catalyst for this massive volume wasn't a flaw in the Bitcoin network at all. It was the Japanese yen.
Exactly. It was a textbook cross-asset liquidation cascade.
Think of it like taking out a home equity loan on a house in Japan to buy a fleet of luxury sports cars in America.
That is exactly what it is. For years, hedge funds in Hong Kong were borrowing Japanese yen at virtually 0% interest, the classic JPY carry trade.
Right.
They took that cheap yen, converted it to dollars, and bought highly leveraged call options on the IBIT Bitcoin ETF, betting the price would only go up.
But then, the Bank of Japan suddenly raised interest rates, and the value of the yen spiked against the dollar.
And the math of their trade violently reversed. Suddenly, the principal on their yen-denominated loan ballooned in dollar terms.
So their prime brokers issued margin calls.
Yep. And when you get a margin call, you don't get to choose what you sell. You have to sell whatever is most liquid.
Wow. And because the silver market had already crashed 20% due to the unwinding of the debasement trade we discussed earlier, their balance sheets were already bleeding.
Exactly.
They were forced to aggressively dump their levered Bitcoin ETF options at any price just to generate the cash to pay back the yen loans.
And remember the market makers who had sold them those options originally.
Right, they had been hedging their own risk by holding spot Bitcoin.
Yes. So when the Hong Kong funds dumped the options, the market makers no longer needed their hedges.
So they programmatically dumped billions of dollars of physical Bitcoin onto the open market.
And the spot price collapses 50%. Not because the technology failed, but because the mechanical plumbing of the options market forces a liquidation.
That is the defining reality of a highly financialized market. Price discovery is no longer dictated by the fundamental value of the underlying asset.
No, not at all.
It is heavily dictated by positioning, hedging, and just the mechanical flows of the derivatives market.
Yeah.
I look at a complex cascade like that, and I can almost forgive a retail trader for getting caught off guard.
Oh, totally.
But it isn't just retail investors getting wrecked by these derivative flows.
Yeah.
I'm looking at this next example from Mark Meldrum regarding the company DigitalOcean, ticker symbol DOCN.
This one is crazy.
I have to ask, how does a sophisticated billion-dollar trading algorithm get tricked by a headline that a human intern could probably decipher if they just read the earnings report?
It happens because algorithms are optimized for speed, not nuance.
Right.
Meldrum's breakdown of DigitalOcean is just a perfect case study in algorithmic failure. The stock opened at $134 and immediately plummeted to $112 in a matter of minutes.
And the trigger was an automated news headline stating the company was repurchasing up to $500 million of their 2030 convertible notes, right?
Yep.
And they were funding this by offering new common stock.
Right, and if you program an algorithm to read the words offering of common stock, it immediately calculates dilution.
Because more shares entering the market means the existing shares are worth less, so the algorithm executes a massive sell order.
Exactly. But they completely missed the options math.
They completely missed the capped call.
Yes. When DigitalOcean originally issued those convertible notes, which is basically debt that can later convert into stock, they purchased a capped call as an insurance policy against future dilution.
Okay, so mechanics-wise, the company bought the right to buy their own stock back at a strike price of $39.17, capped at $66.51.
Right. So when the company issued the new common stock to pay off the debt, they immediately exercised their capped call option to buy back the equivalent amount of shares.
The 15.9 million shares tied to this transaction were already accounted for in their first quarter diluted share count.
Exactly. The shares literally just moved from the diluted column on the balance sheet to the basic column.
So the net dilutive effect of the entire transaction was exactly zero.
Exactly zero. But the algorithms didn't read the Q1 balance sheet, and they certainly didn't understand the mechanics of the capped call.
They just reacted to the headline and dumped the stock.
And in a highly financialized market, if you don't understand implied volatility and options protections, you simply become the liquidity for someone who does.
Wow.
The informed institutional money stepped in at $112 and happily bought up all the shares from the panicked algorithms, knowing the fundamental value hadn't changed a single cent.
So what does this all mean for you?
Yeah, that's the big question.
We are outlining a financial system where the Fed is dropping forward guidance to create intentional volatility,
Right.
where cross-asset margin calls in Japan dictate the price of crypto in America, and where trading algorithms are actively crashing solid equities because they can't read an options contract.
It sounds terrifying.
It does. How are you supposed to invest without losing your mind?
The answer requires a complete shift in psychology. Howard Marks, who is one of the most successful distressed debt investors in history, emphasizes the absolute necessity of acknowledging uncertainty.
Okay.
Marx operates by a very simple rule. No sentence that starts with, "I could be wrong, but ever destroyed a portfolio."
I love that.
Right. It is the absolute certainty, the hubris of thinking you can predict these cascading derivative flows that causes catastrophic losses.
Marx proved this during the 2008 Lehman Brothers collapse. While the entire financial world was panicking, convinced the banking system was permanently broken.
Yeah.
His fund systematically invested $450 million a week for 15 consecutive weeks into distressed debt.
And they didn't do that because they had a crystal ball. They did it using what Marx calls second-level thinking.
Okay, what's first level thinking?
First-level thinking is reacting to the headline. The market is crashing, so I must sell.
Like the algorithm.
Exactly. Second-level thinking requires evaluating the mechanics and the probabilities. Marx reasoned that if the global financial system actually collapsed, money wouldn't matter anyway.
True.
But if it didn't collapse, if the panic was just a temporary liquidation cascade, the mathematical upside of buying assets at those distressed prices was generational.
You take that emotional control and you pair it with Raoul Pal's structural advice. Pal's thesis is bluntly titled, Unfurk Your Future.
It's a great title.
You don't secure your financial future by trying to day trade the yen carry trade on a Tuesday morning. You survive this era by anchoring yourself to long-term secular trends.
Hal advises positioning capital in the foundational technologies that are actually rewriting the economy. Blockchain infrastructure, artificial intelligence, the tokenization of real-world assets.
Because if AI is going to exponentially increase GDP, and if central banks will eventually have to ease monetary policy to manage the sovereign debt load,
Then the logical strategy is to hold the scarce assets that benefit from those two specific macroeconomic gravity wells and just ignore the daily options market static.
to wrap this all up, we've journeyed from the theoretical limits of carbon versus silicon compute down through the K-shaped realities of central bank policy and $12 peanut butter,
Right.
right into the mechanical plumbing of synthetic supply, capped calls, and algorithmic panics.
The macro environment sets the weather, but the options market is the lightning striking the ground.
I like that.
Which raises an important question, a final thought, to really build on everything we've dissected today.
We have seen how synthetic derivatives, these layers of paper claims, can completely overwhelm the mathematically hard-coded scarcity of an asset like Bitcoin.
Yeah.
We have seen how AI is poised to fundamentally rewrite the rules of economic productivity. Are we entering a financial era where the map, the derivatives, the options flows, the synthetic data models permanently replaces the territory?
Meaning the underlying physical assets and actual human labor.
Exactly. What happens to the global markets when the autonomous AI agents trading this options flow become significantly smarter and exponentially faster than the human lawyers and bankers who originally wrote the contracts?
If the underlying mechanics are breaking down now, just wait until the algorithms start rewriting their own rules.
Something to mull over until next time. Thanks for taking the plunge with us.